I want to talk to you about inventory accounting, and of course, we are speaking about inventory management. So, accounting plays a quite essential role when it comes to valuing your stock properly. So, here is the benchmarking I want you to pay attention to. The thing is that there are three primary methods of inventory accounting that allow you to accurately calculate both the value of your unsold stock and your cost of goods sold. Okay, so inventory accounting is a critical part of financial management for any business. I don't care if you are in retail or you are in you even if you have an online store. So proper inventory accounting facilitates accurate financial reporting, efficient operations, and also helps you meet customer demand in a properly manner. So let me first define for you what inventory accounting really is. So when you think about inventory accounting, I want you to think about the methodical recording, tracking, and valuation of a company's inventory. That is basically you have a complete list of merchandise and materials held by the business for selling in the market and earning a profit. So, tracking inventory is really a quite essential to get an accurate picture of a business's financial health and also ensure that the business has enough stock to meet customer demand without overstocking or incurring unnecessary stock cost. Okay. So proper inventory accounting is actually required by US GAAP, so generally accepted accounting principles. So that's important, and also IFRS. So you're speaking about US GAAP, but also IFRS. So now, how does inventory accounting work? Basically, inventory accounting works by assigning cost to inventory items as they move through the production process and are eventually actually sold to customers. So those costs are determined under either the cost method or market value method. Now, under the cost method, you assign cost to inventory goods based on how much you are charged to acquire the goods, typically purchase price and shipping. Under the market value method, you assign cost based on a good's current market value, which can rise and fall over time, right? In either case, it's important to note that inventory is considered a current asset under GAAP, which means what? If it's not, it's basically not depreciable, unlike a company, vehicle, or equipment. Now, let me talk to you about how inventory accounting affects cost of goods sold and inventory valuation. Now, cost of goods sold and inventory valuation, two critical financial management metrics, depend on properly accounting inventory. So, when determining cost of goods sold, the formula is I'm going to put this on the screen. So, cost of goods sold equal beginning inventory balance plus purchases minus ending inventory balance. So I'm going to put this on the screen. So if your inventory at the beginning of an accounting period, so just a month or a quarter or half a year, is valued at say $5,000, and you purchase $3,000 in additional inventory and end the same period with an inventory value of $2,500, here is how you would calculate your cost of goods sold. Again, I'm going to put the formula on the screen. So cost of goods sold equal 5,000 plus 3,000 minus 2,500. So the cost of goods sold under this scenario will be $5,500. Okay. So as you can see, inventory valuation is calculated. It's actually calculated by assigning specific values to a product that actually remain in inventory at the end of the accounting period, either based on the cost of acquisition or fair market value. So what's included in inventory accounting? Well, basically, you have all kinds of metrics. You have materials, you have work in progress goods, you have finished goods, you have MRO supplies. So, MRO, I'm speaking here about maintenance, repair, and operation supplies. Those include materials that are either used up in the production process but not included in the final product. They can include personal protective equipment, cleaning supplies, office supplies, and tech equipment. You also have resale goods. So these are products that customers return but are of sufficient quality to actually sell again. And when I speak about materials, those are raw materials, okay? This might include raw materials, wood, cotton, etc., and components screws, microchips, zippers, etc., that go into manufacturing a product. And when you hear the word work in progress goods, those are goods that are in the process of being manufactured. For example, a clothing company might include half finished dresses in its inventory accounting. So when you think about inventory accounting, that's what I want you to really think about: a long list of inventory items that go from raw materials and go all the way to resale goods and MRO supplies. So, what are the benefits here? So, what are the advantages of inventory accounting? When you think about inventory accounting, you have benefits such as accuracy in financial reporting, efficiency in inventory management, your ability to meet customer demand, and also you have to think about tax compliance. Let me explain further. First of all, when you have accurate financial reporting, so implementing proper inventory accounting ensures that your company's balance sheet reflects the accurate value of its inventory assets. So we are speaking about a compliance model with the US GAAP or IFRS. So this accuracy extends to financial statements, providing stakeholders or potential investors with reliable information for decision making. Okay, so and again, you can have also lenders, not just investors, but also lenders. You also have efficient inventory management. So, inventory accounting actually does a great job because it allows your business to manage inventory levels and also ensure that you're not stuck in too much inventory or overspending on storage costs. So, when you think about inventory level, this is the same thing as inventory control. Okay. So, by understanding which items are fast moving and which may be obsolete inventory, your business can make informed decisions to avoid this risk of overstocking or understocking. You're also able to meet customer demand. So, with accurate tracking of inventory levels and sales patterns, your business can ensure that it has enough stock to meet customer demand, which actually might fluctuate seasonally. And this not only enhances customer satisfaction by ensuring product availability on a ready schedule, it also helps maintain a positive cash flow because you are actually optimally running your inventory your inventory model. You also have tax compliance. So proper inventory accounting is a critical aspect of tax compliance. It really enables your business to accurately calculate taxable income, ensuring compliance with tax regulations and also avoiding penalties. Let me talk to you about calculation here. So there are three top methods for inventory accounting. So you have FIFO, LIFO, and weighted average. So when I speak about FIFO, FIFO stands FIFO stands for first in, first out. This is arguably the most common method for inventory valuation. It assumes that the first items added to the inventory are the first to be sold. What this means is that cost of goods sold is calculated using the cost of the oldest inventory, while the ending inventory is valued at the cost of the most recently purchased items. Let me break it down with an example. Say you own and operate a company that sells graphic printed hoodies. And so on November 1st, 2023, you purchased 100 blank cotton hoodies for $8 each. On November 15th, 2023, you purchased an additional 100 hoodies, but your regular supplier has raised its price to $10 each, and you purchased 100 hoodies at the new price. So let's say your supply dips in late November. So on November 30th, you buy 100 additional hoodies from another supplier who prices the goods at $9 each. So to properly track inventory cost in any inventory, you need to incorporate all three prices into your inventory accounting, as this will directly impact your cost of goods sold and inventory's overall value. So you would record the inventory purchases as follows. I'm going to put this on the screen so you have a clear idea. So we have three lines. So we have the first 100 hoodies at $8, 100 hoodies at $10, and 100 hoodies at $9. So I'm putting this on the screen. So aside from making this inventory purchases, basically, let's say you also received two significant customer orders on November 17th for 125 hoodies and another on November 30th for 150 hoodies. Here is how you would value inventory purchased on November 17th using the FIFO accounting method. So I'm putting this on the screen so it's pretty clear to you what kind of a strategy you need to really go through. So I'm putting this on the screen. So under the FIFO method, the above include the first hoodies taken into a stock at $8. The remaining hoodies in the order were accounted for under the second price offered by your regular supplier at $10 each. Now the next order completed on November 28th will be recorded as, again, I'm putting this on the screen here. So 75 hoodies, and total cost of inventory, $14.25. Again, all these things, it's really important that I put it on the screen. So the total cost of goods sold for the month will be actually 0 plus 2,700 minus 225, and cost of goods sold $24.75. Again, if you have any question, let us know in the comment section. Let me talk to you now about LIFO. So basically, last in, first out, or LIFO, evaluates inventory based on the assumption that the last items purchased in your inventory will be the first to be sold. So using the same example as above, as earlier, here is how your inventory totals will be determined by LIFO. So the first order on November 17th will be, again, I'm putting this on the screen, 100 hoodies, 25 hoodies, and total cost of inventory at $1,000. So under LIFO, because the $10 hoodies were the last inventory items to added before the November 17th order, they are the first to be sold. And the next order completed on November 30th will be 100 hoodies 100 hoodies times 9, 50, and so the total cost of inventory here will be $1,300. Again, I'm putting everything on the screen. If you have any question, please don't hesitate, because inventory accounting could be a little tricky, so we can certainly explain to you a little further. So if you, under the LIFO method, after both orders are completed, you are left with 25 hoodies, all valued at $8 each, or $200. Remember, last in, first out. So the last on the LIFO, because you really have those $8 hoodies last in. They're actually, they first came out. So you have other inventory. So your cost of goods sold using the LIFO method for November 2023 would be, again, I'm putting this on the screen, cost of goods sold equal 0 plus 2,700 minus $200. So you have a cost of goods sold of $2,500. So you can see that the cost of goods sold under LIFO is totally different from the one you have under FIFO, right? Under FIFO, we had $2,475, and under LIFO, we had $2,500. So you have a delta of $25 there. So let me talk to you about the weighted average here. So weighted average is the third inventory accounting method. So besides FIFO and LIFO, you have a weighted average cost. Sometimes they say WAC. So the weighted average method takes the average of the total cost of your inventory. So using the same hypothetical example, so the hoodie example, you would add up the cost of all three inventory purchases for the month of November. Okay, so basically you have $800 plus $1,000 plus $900. So remember, so $800 because you bought 100 hoodies at $8. You bought 100 hoodies at $10 and 100 hoodies at $9. That's how you got 800 plus 1,000 plus $900. So the total cost is $2,700. So you would then divide your total monthly inventory cost by your total inventory count for the same period. So basically you have what? You have 300 hoodies. You bought 300 hoodies, right? So the math actually is pretty straightforward. That's 2,700 divided by $300 equal $9. So using the weighted average method, your ending inventory valuation would be 225. 225, how did I get it? You multiply $9 by $25. So 25 hoodies. So sorry. So $9 by 25 hoodies. That's equal to 25. And that will leave us with a cost of goods sold of 24.75, because cost of goods sold will be equal to 0 plus 2700 minus 225, and final number here, 24.75. Now, it's just a coincidence that the weighted average cost is the same thing as FIFO. Usually it's not, but in our hypothetical example, it is. But yeah, it just explains that you will have different numbers depending on the inventory accounting method that you actually choose. So what are the extras here? When you think about inventory accounting, it's important to understand that this is actually it's a highly regulated procedure that allows you to comply with US GAAP, that allows you to comply with IFRS, International Financial Reporting Standards, and also you want to be in compliance with tax regulations from the IRS, but also from state tax authorities. Okay, so inventory accounting plays an important role in making sure that your balance sheet is accurate, that your your income statement is accurate, your cash flow statement is accurate, that also your statement of owner's equity is accurate. So inventory accounting is important because it provides an accurate reflection of your business's financial health by properly recording inventory values on financial statements and balance sheets. I mean, the thing is that you want to really appeal properly to all kinds of stakeholders, including lenders, including investors, including VC capital firms, including also your contract holders. I mean, your suppliers and vendors. Some vendors might actually ask for they might ask for financial statements before granting you net 30 accounts, net 30 contracts, and that's business credits. Okay. So the cool thing is that when you think about inventory accounting, you have a procedure that promotes optimal stock levels, prevents overstocking or stockouts, and ensures the business can meet demand. And so inventory is classified in accounting as a current asset. It is a short-term asset or current asset. Okay, this means this asset is expected to be converted into cash or used up in the near future, usually within an operating cycle, typically a year. So this classification is important because it distinguishes between short-term and long-term assets, providing insight into a company's immediate liquidity and ability to meet short-term obligations. Okay, and you have to report inventory. Okay, if you are a business, at least in this country, you are generally required to report inventory as part of your financial statements. Okay, so in the U.S., inventory reporting rules come from the U.S. Security and Exchange Commission and the Internal Revenue Service, as well as state tax authorities. So here's the bottom line to this conversation. I explained to you how to use 3 inventory accounting methods. I spoke about benchmarking, the benefits, the calculation, and also the extras. Thank you so much. God bless you. I will speak to you another time. Until then, remember, stay marvelous.